Hello, everybody. Welcome to the seventh episode of Prelims Basics. And as promised, today we are going to deal with fiscal deficit. Now, what do you mean by fiscal deficit? So, in the last class, basically, we saw about the annual financial statement and we saw about the breakup capital budget, revenue budget. Revenue expenditure minus revenue receipts plus capital expenditure minus the non-debt creating capital receipts. Non-debt creating capital receipts means you're not including loans here. Loans are not included. You're only talking about what here? You're only talking about disinvestments. Clear, people? All right. So basically, this gives you a clear idea how much money has to be borrowed to handle the FD. That is the reason why fiscal deficit is such an important indicator, because if your revenue expenditure is more or your capital expenditure is more, then clearly you have to what borrow money now to fund your deficits. For that, what you will do, either you will borrow internally, say from public account of India or from RBI, or even through the SLR facility from banks, or you can borrow externally, that is from abroad in foreign currency, dollar, euro, yen, etc., or even in British pound, or you can raise the taxes. Clear, like how the government has increased the central excise duty for petrol and diesel, correct? Or the last option is what you can print money. But this one option here, Government of India has decided to stop printing money whenever there is fiscal deficit. Now, how much amount of fiscal deficit is good? That is, if fiscal deficit is because of revenue deficit, why revenue deficit? Revenue deficit happens when revenue receipts are less than revenue expenditure. Or in other words, what comes under revenue expenditure? Your defense payments, your interest payments, your public administration payments, your subsidies, all these are high. In such a case, what happens? None of this will lead to what? None of this will create any capital. These are just consumption expenditure, correct? So if your fiscal deficit is because of revenue deficit, that is bad news. That clearly means your country or your state is going to what is economically default in the future. In the case if fiscal deficit is because of capital expenditure, it is not that much of a bad news. Why? Because capital expenditure eventually goes for what? Infrastructure. That is either economic infrastructure like roadways, railways, etc., or social infrastructure, both of which will contribute towards growth in the future. So fiscal deficit because of capital expenditure is good news, whereas fiscal deficit because of revenue deficit is bad news. Why? Because you will have to use a part of the capital money kept for capital expenditure. You will have to use it for what? For funding your consumption needs. That is your revenue expenditure. So what is the ideal value for fiscal deficit? According to the FRBM Act, 3% of GDP is considered to be the ideal level. And Government of India has been trying very hard to maintain the FD at that level. But because of Corona, the values have went up royally well. Fiscal deficit has gone up and now they are trying to bring it down. Now, so the point here is, now I told you borrowing internally, borrowing externally, taxes. These are the three methods available: borrowing internally, borrowing externally, and taxes. Now, in such a case, if you are going to borrow externally, what is the issue? Borrowing externally means what happens is each and every time a dollar appreciates or rupee value depreciates, that will affect the amount that you have borrowed. So this can become very costly affair. Whereas internal borrowing means the idea here is what? Whatever money you have borrowed, you should be able to pay the rate of interest. Clear, people? And how will a country or a state be able to pay the rate of interest for the money borrowed internally? For that, the minimum condition is the rise in GDP should be more than the interest payment for the debt to be sustainable. And for India, always the rise in GDP has been more than the interest payment, barring a few years. This has been given in your economic survey. In a graph, it has been given. Please check it out. Then, let me introduce you to two terms, the last two terms for the class now, which is negative tax multiplier and Ricardian equivalence. So negative tax multiplier, what it says is, if you increase the tax, consumption will decrease. And if you reduce the tax, consumption will increase. Simple logic. And as you can clearly see, both are moving in opposite direction. If tax increases, consumption goes down. And if tax decreases, consumption goes up. That is why you call it negative tax multiplier. Clear? And it is basically said that government multiplier. What multiplier? Investment multiplier. Government investment multiplier is greater than tax multiplier. Means what? If actually government starts spending more money, then that will have a huge impact on the level of income that people have compared to the tax levels. That is, just because if you reduce the tax, people's income will increase by a slight amount. But it is not necessary that all of them will start what? Spending all that money. Correct. But on the contrary, if government starts spending more money, people's income will increase. Directly, the income will increase. As a result of which, the spending also will be more compared to what? The spending in tax saving. Clear, people? That is why they say government investment multiplier is more than tax multiplier. Now coming to Ricardian equivalence. So in the event of a high fiscal deficit, okay, there are two options with the government. One is to borrow now, and later to pay back that amount, you will tax the people. Or the other thing to do is what? No need to borrow, straight away tax now. All right. Both the ways, if you do this also, if you do taxing now also, both are what? The having the same equivalent effect. And that is called Ricardian equivalence. For high fiscal deficit, government will borrow more. Okay, when the deficit is high, what will government do? Government will borrow more. And this will reduce what? The savings available for private sector, leading to crowding out effect. Clear? That is one disadvantage when you have high fiscal deficit. What is the other issue? When high fiscal deficit is there, then if it is because of revenue expenditure, what will happen? It will lead to inflation, which will become unsustainable. On the contrary, when fiscal deficit is because of capital expenditure, you will have increased income and you will also have increased demand. But because of capital expenditure, now what happens now is goods and services production also increase. So the demand is also more, supply is also more. What happens? Price levels more or less remains stable. Clear, people? With that, we come to an end of today's class. Hope you understood it. Any suggestions or any doubts, please put it up in the comment section. Happy studying. God bless. Take care.